I'm gonna give you guys a sobering statistic today. Most investors, both professional Wall Street managers and everyday retail traders, fail to beat the S&P 500. We look at the SPIVA scorecards, which is the S&P indices versus active, and it tracks the performance of active funds globally. The historical data delivers a nearly unanimous verdict against active stock picking. First year, roughly 60 to 65% of active large cap mutual funds underperform the S&P 500. After 5 years, the underperformance rate jumps to around 76%. 10 years and about 84% of professional managers lag behind the index. 20 years, a staggering 92% of domestic equity managers fail to beat their benchmark. If you pick a random, professionally managed active mutual fund today, there is only about an 8% chance it will outperform a simple low-cost S&P 500 index fund over the next 2 decades. Furthermore, studies on performance persistence show that managers who land in the top quartile 1 year have a near zero statistical probability of staying there just a few years later. The data for individual retail investors is even more brutal. The average individual investor underperforms the S&P 500 by a massive 4 to 6% annually over rolling 20-year periods, according to the data reports from Dalbar Incorporated. Look at the 20-year annualized returns by asset class. The S&P 500, which is the large cap stocks, 9.5% annualized return. A 60-40 balanced portfolio, 7.4%. Bonds, which is fixed income, about 4.3%. Average retail investor, 3.6%, while inflation is at 2.2%. I personally reject the idea of trying to predict the exact bottom or top of a market cycle. Market timing relies on forecasting the future, which is an exercise largely futile, because it depends on predicting unpredictable short-term investor psychology. Instead of looking forward to guess what will happen, taking the temperature means looking closely at the present to understand where we currently stand in the market cycle. You see, the market behaves like a pendulum, swinging between extreme optimism, greed, and extreme pessimism, fear. To take the temperature, an investor acts as a psychologist rather than a forecaster, asking questions about current market behavior. Are investors disciplined or reckless? Is capital cheap and easy to obtain, or scarce and tightly locked away? Are people terrified of losing money, or are they terrified of missing out, FOMO? You see, when everyone is optimistic, deals are closing effortlessly and structures are loose. It is time to be highly defensive. When the temperature is freezing, there is panic selling, widespread pessimism, and zero liquidity. It is usually a great time to be aggressive because assets are being mispriced below fundamental value. You don't need to know when a trend will reverse to know what the risk-reward profile of the market has changed. If the market temperature tells you valuation metrics are wildly elevated and structural risks are ignored, you calibrate your portfolio toward capital preservation. Take the current temperature of the market. We look at objective indicators of valuation and credit risk. These numbers serve as a proxy for current investor psychology, revealing whether the market is currently driven by fear or greed. Here are the primary ways to take the market's temperature across equities, credit, and sentiment. 1. The equity valuation metrics, the price of assets. These indicators tell you how much investors are willing to overpay for a dollar of earnings due to optimism. The Shiller P/E CAPE ratio measures the S&P 500 price relative to a 10-year average inflation-adjusted earnings. Historically, the median sits around 16 or 17. When it pushes into the high 30s or 40s, as seen during the dot-com peak, and again hovering around 41 today, the equity temperature is boiling hot. The Buffett indicator measures total market capitalization relative to GDP. It reveals stock prices relative to the size of the actual economy. An ideal buying temperature is between 70 and 80%. When it accelerates past 150 toward historic highs, climbing over 233% today, it is highly saturated, greedy market. 2. The credit risk metrics, the cost of capital. I want to heavily emphasize looking at the credit markets because bond investors are structurally designed to be pessimistic. If they get greedy, risk is everywhere. High yield bond spreads. This measures the extra yield corporate junk bonds must pay over risk-free US treasuries to attract investors. A historical average is over 5%. When corporate spreads compress significantly down into 2.6 to 2.7% range, it shows that the capital is incredibly easy to obtain. Default risks are being outright ignored. Investors are completely complacent. The credit market behavior, if companies can issue debt with weak covenants or low yields easily, the thermometer reads hot. If even solid companies struggle to find funding, the market is freezing. Number 3, the quantitative sentiment indicators, which is the investor behavior. These metrics monitor how investors are actively positioning their capital in real time. I want to introduce the equity risk premium EPR, that is the expected excess return an investor receives for holding stocks over risk-free government bonds. A highly compressed ERP means investors are demanding very little extra incentive to take on the risk of equities, which is a classic sign of market euphoria. Next, the VIX, the volatility index. Often it's called the market's fear gauge. A sustained VIX below 13 or 15 implies total calm and a lack of defensive hedging by institutional players. A VIX spiking past 30-40 implies freezing panic. Next, number 4, qualitative behavioral signs. Taking the temperature requires listening to the narrative around you. You see, how market greed. Deals are winning solely based on speed rather than due diligence. Missing out, FOMO, is viewed as a bigger risk than losing money. Anyone sitting in cash is mocked for missing the rally. When the market is cold, fear. Nobody cares about future upside. Everyone is terrified of further downside. The good news is ignored. Asset sales are forced by margin calls, and people assume the system is permanently broken. The present stock market concentration is unprecedented, with top 10 companies making up 40% of the index. The overall market index can look incredibly strong even if the broader economy or the average company is struggling. The market's stability rests on a very narrow foundation. If one of these top companies misses on earnings report or faces regulatory issues, its sudden drop can drag the entire market down with it. High concentration means that buying an index fund effectively turns into a massive bet on a single sector or a tiny group of corporate executives. This creates a self-fulfilling loop. The largest companies get the most inflows simply because they are the largest, driving their valuations to historically high levels. Historically, extreme market concentration does not last forever. It usually revolves in one of two ways. One, a healthy rotation. Investors realize mega caps are overvalued and start moving capital into lagging sectors. Two, a sharp correction. A catalyst such as rising interest rates, antitrust regulations, or a tech bubble burst causes the dominant companies to plummet, forcing a painful market-wide correction or bear market until valuations normalize. Now, that being said, by aggregating these metrics, you can quickly determine whether you should be dialing up your defensiveness, like building your cash position, or preparing your shopping list to aggressively buy risk assets. As of today, the market pendulum is swung heavily toward optimism and greed. When high yield spreads are compressed and equity valuations are near historical extremes, risk is high, prospective long-term returns are low, and it is time to emphasize caution over aggressiveness. It doesn't mean a crash happens tomorrow. Taking the temperature won't tell you the timing. It tells you that structural environment demands high disciplines and defensive positioning. Now, I want to introduce my two ETF portfolio, SPMO and BIL, BIL. It is essentially a barbell portfolio. One side is pure risk-free liquidity, BIL, and the other is a high-octane equity engine, SPMO. By dynamically shifting your buy allocation based on market temperature, you are forcing yourself to buy low and lock in safe yields when risks are high. Now, using BIL, BIL, which is the stage 3, 1 to 3 month Treasury bill ETF, is an excellent choice for your cash cushion. It gives you a safe, steady yield around 4 to 5% depending on the macro environment with virtually zero price volatility. It keeps your capital perfectly liquid and ready to deploy at a moment's notice without the risk of loss of principal. The SPMO engine, the Invesco S&P 500 Momentum ETF, focuses on the stocks showing the strongest price persistence. In an extended bull market, momentum strategies historically tended to outperform the broader S&P 500 because they heavily weight the absolute winners of the current cycle. By committing to buy more BIL, BIL, when indicators like the Schiller PE are boiling, you build an automatic mechanism to take chips off the table when everyone else is greedy. It is a highly disciplined, intuitive strategy, but to make it work safely with a momentum ETF, you need to define when you pivot your buying. Instead of buying SPMO while the knife is falling during a crash, the optimal time to heavily rotate from BIL into SPMO is after a sustained correction has stabilized, or when market sentiment indicators show that fear has peaked and stabilized. This ensures you are buying SPMO when its underlying holdings have finished their steepest declines and are ready to ride the next momentum wave upward. A variation of this portfolio is to introduce an income engine as time passes and one needs more income. This also depends upon your age or your financial objectives. Past 40, I would recommend that the portfolio percentage of QQQI is your very age. Adding a high yield Nasdaq cover call ETF like QQQI introduces a highly effective third lever to your strategy, especially as an income-focused anchor. Here is how this dynamic changes your portfolio structure and why it can work beautifully if it handled correctly. By adding an income engine, your 2 ETF system evolves into a sophisticated 3-part machine. The growth engine, pure equity upside, capture maximum appreciation during bull runs and recovery phases. The income engine, QQQI, caps upside potential in exchange for high monthly distributions, typically 12 to 15%, and the dry powder, BIL, with zero volatility principal preservation. It earns risk-free interest and waits for crashes. The single best reason to add a cover call fund to this specific setup is the cash flow velocity it creates during a hot market. When the market temperature is boiling good, equity growth slows down as valuations stretch. Your cover call fund will thrive in this environment, pumping out massive monthly cash dividends because high volatility pumps up option premiums. Instead of manually selling your winners to build up cash, you can take that 13% yield directly from QQQI and funnel it straight into BIL. You are naturally harvesting high yield cash and piling it into risk-free dry powder without triggering structural asset sales. Now, if the Nasdaq crashes 30%, QQQI will drop sharply along with it, though slightly cushioned by the option premium collected. Therefore, you do not want to use QQQI as your safety component. BIL remains your only true defensive anchor. Integrating a high-yield Nasdaq ETF into strategy is an excellent evolution for generating cash flow, provided you assign the right job. Don't buy it during crash. When the market temperature hits freezing cold, do not use your bill dry powder to buy QQQI. Use your cash to buy the pure growth engine SPMO to capture 100% of the uncapped recovery. Use QQQI when the market is moving sideways or grinding up slowly. Let it spin off income. Siphon that cash into bill and wait. Now, a variation of it could be the 90-10 allocation. Go 90% QQQI and 10% bill. This bumps up your blended portfolio yield up to roughly 12.8%, pushing your income stream even faster so you can stack cash into BIL. Or a more conservative portfolio, the 80-20 allocation. Go 80% QQQI and 20% bill. This drops your yield around 11.8%, but it instantly doubles your risk-free dry powder cushion, giving you a bigger buffer and peace of mind. Understand that with a portfolio variation talked about in this video, you get over the S&P 500 historical return. You never have to worry about when to sell, removing the human error. And you will have the dry powder to deploy when the opportunity presents itself. This is exactly what I would do if I were to start over today. Now think about it. When the S&P 500 delivers about 10.5% annualized average with this portfolio that I have suggested to you, even if I have suggested a few variations, you can go with 90-10, and in that case, your portfolio is going to generate 12.8 yield annualized, which is already over the S&P 500. At the same time, you're gonna have the dry powder at the right moment to deploy. I really feel that this is helpful. If you have any comments or questions, feel free to reach out. I'm here for you guys. Peace out.